What about the market? That's something we'll try and decode with Mukul Kochhar, the head of Institutional Equities at Investec Capital, joining us on the show. Mukul, hi, good to be speaking with you. That's exactly the first question. When you're speaking with your peers on the buy side, what's the market mood right now? Are they finding more difficult to find opportunity in the market, or not really? The large caps are still something which is providing comfort.
So, Anisha, when you're putting capital at risk, it's always difficult, right? So, moreover, last year has been fairly solid, especially in the mid-cap side, 58%. Large caps also were fairly solid performance last year. So, you're coming off a very strong year, and therefore the little bit of trepidation, but some sort of difficulty in putting money at work is very common, right? But having said that, given the context of the strong last year, you're seeing this volatility. There is some nervousness, hence. I mean, having said that, there are enough ideas to answer your question. Then there are enough ideas to go around. We have been recommending clients overweight on autos. We have been recommending clients overweight on financials. We are very bullish on pharma as well. So we continue to find ideas, and it is possible to put money at work even in this market, as it is always, I think.
To financials, pharma, these are the top 3 overweights you're recommending right now. Let's decode one at a time. Autos, because of course the big theme is EV transition, etc. How you're playing it through the direct, passenger vehicles and two-wheeler plays, or do you think OEM is a better way to play it?
Yeah, so Anisha, in EV, I think there's going to be a transition in the story in how people look at the sector. It's going to transition more towards ASP growth, the narrative, which is been the narrative in India. In India, it's always been volume-led narrative. Premiumization is going to be a big play going forward. EVs is a part of that. We are actually, in general, we've always been more constructive on the two-wheeler space. We just see that the two-wheeler side of the business more settled. There are no new players coming in. The Indian companies are the largest and most profitable companies in the world as well. So that's a more sort of structured, stable, disciplined sector for you to invest in. Having said that, a couple of two-wheelers are also looking interesting, but we generally prefer two-wheelers. And the narrative, for the next few years is going to be around premiumization, ASP growth.
Prefer the two-wheelers. That's the clear verdict there. But let's talk about financials as well. The space which is underperformed and bored investors for the longest time, and everybody's asking that question: when will it come back to growth? Especially the large cap private banks. So a two-part question there. A, PSU banks have run up quite a bit. Are you suggesting people to move out of PSU banks into private banks?
The thesis on the private banks and the PSU banks is totally different. And I think we have ideas in both. In the private banks, it was a situation of margin correction last year. In general, stocks do not work, and this goes for any stock, not just banking stocks. Stocks do not work when margins are under pressure. We think that story sort of stabilizes, or the margins stabilize here, or may even outperform very muted expectations even for FY25. Part of the reason being that what the street is building in further margin pressure from RBI rate cuts. A lot of products in banks are linked to repo. I think that may not come through this year. So you may see some upgrades on margins this year on the private side. And selectively, we are positive on private banks for that reason. We also generally, we've written a note on this as well, that there will be better pricing power with private banks this year because excess liquidity or surplus liquidity in the system has largely sort of paid out, and now financial institutions are pushing less for growth, and here banks with surplus liquidity will have better pricing power. On the PSU bank side, it's more a valuation play. These are, we believe, for the next 3 to 5 years, 15% ROE entities, and some of these guys at least are trading at also still reasonable valuations despite the steep run-up. So selectively, we are positive both on PSU banks and private banks, depending upon their story and valuation that they're trading in.
See some valuation comfort in select PSU names. That's a verdict coming up. The other one that you talked about was pharma, right? Seems like it's coming back quite a bit on investors' radar as well. And today itself, there's a lot of clarity around how CDMO businesses seem to have bottomed out and it's going to take from here on. Which end of the pharma space are you looking at? Because of course hospital stocks had done quite well for themselves. A lot of action in diagnostics as well. Which end of the market are you most positive on?
So within healthcare, pharma is the segment that's looking most attractive to us. We believe after years of being over-invested, the sector is getting a dose of sanity as far as capital allocation is concerned. Just this morning, we got a confirmation of drug shortages in the US, which actually sort of makes the export side of the business quite attractive to us. Just to point out, we've been at the forefront of this improving pricing in the US. Our analyst has been talking about it for some time. We believe that pricing power will remain with pharma exporters. The domestic business is good as well. There's capacity is getting played out. Drug companies are more and more careful in adding incremental capacity. We expect this sector to continue to outperform. Just remember that despite the sector doing well in earnings as well as price movement, it is still not adequate return on capital. So companies will be cognizant of that before they add new capacities. So structurally, we believe that the sector has more room to run.
Okay, so the good news is that the pricing is coming back and export demand too is something which is picking up. So those are the sectors that you're positive on. But Mukul, which are the spaces that you would recommend people take some money off or perhaps profit book a bit? Real estate comes to mind?
See, real estate has always been a very tough sector. It's also run up quite a bit. Having said that, real estate cycles are very, very long-lived. So expect at least the fundamentals to be very strong. I think the stocks, I believe the stocks have run ahead of themselves right now, but at least there's no negative catalyst in terms of momentum in the business because real estate cycles tend to be very long-lived and this one has just started. Where we are more certain of taking a negative stance is cement, where we think right now the sector has added capacity and the street is way ahead in terms of expectations from the sector. So broadly, we are underweight cement. We are also substantially underweight core FMCG stocks. We believe staple demand will be slower in this cycle, 3 to 5 years. Staple earnings growth will be slower in the next 3 to 5 years because of increased competition in distribution, etc. And the multiples that they have enjoyed in the last cycle will increasingly come under question. So these are two clear underweights that we are running right now. IT sector is another one where we believe demand will be slower. Rupee benefits that they have been getting over the last 10 years or so of continuous depreciation that may not be at play, and multiples remain high. So these three sectors are clear underweights for us.
FMCG as well as these are the three sectors that you perhaps have a bit of an underweight on. But before I let you go, Mukul, what's the view coming in on telecom, if you have it there? Because suddenly there's a lot of action with Bharti Hexacom getting listed, Vodafone perhaps doing a 18,000 crore worth FPO, and what we hear from sources tell us that it's getting a decent amount of traction.
Yeah, so Bharti Hexacom is it's a good story in general, and that's probably getting reflected in the stock price. Broadly, the sector is looking good, right? And pricing power is going to be fairly reasonable. We believe that this year, pricing power may be even stronger than last year, and that is what is driving the sector. It's not exceptionally expensive by any metric. It's not done exceptionally well over the last decade or so. So the sector broadly is looking well priced, looking good. Moreover, the consolidation that needed to take place in the sector has largely played out, which allows incumbents to increase prices in a rational manner. I'm not saying there's anything irrational going on. Return on capital always needs to exceed cost of capital for companies, and this sector, I think that cycle has come now. So we like the telecom space.
Finally, it's time for telecom to shine as well. Thanks, Mukul, for making time and speaking with us. A pleasure speaking with you on ET Now today.
If you like this video, then like, share and subscribe to ET Now.